All the market is trying to do is discover its most acceptable price, the fairest price. The same can be said for companies like Apple or Amazon. Every single day, we see the valuation of these stocks fluctuate continuously as traders and investors figure out what the most fair price is at the current moment. The fluctuations of price through a period of time can be analyzed in many ways. The market profile is one such way to analyze this data. And when using a market profile, there are a few components that you need to know about. Number one, the value area. This is where 60 to 70% of all trading activity occurred. Number two, the point of control. This is the singular price where the most amount of trading activity occurred. Number three, we must keep in mind that prices above or below the value area are considered to be extremes, or unfair highs and unfair lows. All of this occurs through what's called distribution, or the bell-shaped curve. A book of the market profile written by the CME has this to say on one of the first lines of the first chapter, and it goes like this. Distribution is the position, arrangement, or frequency of occurrence over an area or throughout a space or unit of time. The value of everything distributes around a mean over time. Why should trading volume be any different? Looking at the image to the right of the text, we can see a bell-shaped curve where price is vertical and time is horizontal. We can also see where 70% of all trades have taken place, which is the value area, and we could also see prices above value and prices below value. Sticking to the topic of the value of distribution, here's a fantastic real-life example of how distribution is used. So this is an image of a distribution from TrueCar.com. The concept behind finding the true value of a vehicle in your area is the same as the market profile. We can see prices that are below value, prices that are above value, and prices that are inside of value. Sticking to the example of a vehicle, as the seller of a vehicle, I would love to sell above value because I'm making a bigger profit than those dealers who are selling their cars inside of value. And as a buyer of the vehicle, I would love to buy below value because I'm getting a better price than those who are buying inside of value. Shifting this over onto trading, above value are unfair highs and below value are unfair lows. I want to be a seller above value and I want to be a buyer below value. Now, as mentioned in the previous slide, the volume of everything distributes throughout a mean over a period of time. So selling above value, at some point in time, we're going to revert back into the mean. And if we're buying below value, at some point in time, we're going to revert back to the mean. So in a trading example, if I'm short above value, I want to cover inside of value. And if I'm long below value, I want to exit my position or sell my position inside of value. I never ever want to place a long or buy order or short sell order inside of value. Too many transactions occur there, and I'm selling what everybody else is buying. I want to take advantage of prices above value and prices below value. This is how we can unlock the best bang for our buck.